Hey guys, JC Parets here, and I am joined by my esteemed colleague, Mr. Sean McLaughlin. What's up, Shawnee baby?
What's happening, JC?
Oh, just looking at some charts, listening to good music, and our Young Aristocrats report, the Little Aristocrats, is dropping. One of the things I've always admired about you, Sean, is that you don't care about our credit spread conversations. You don't care about our US dollar conversation. You just want to know what the trade is.
No, and I wrote about that in our blog post today. I playfully play along with you guys when you're starting to geek out on that arcane interest rate crap. But, I get real excited when we start talking stocks. And, Wednesdays are my favorite day, man, because we all get to hang out as a team and talk about what we're seeing in the markets. And it's my favorite day of the week, man. Hump day. I love it.
So we're talking, intermarket analysis and all sorts of US dollar implications. And Sean's like, so about that options trade, that Valvoline.
Yeah.
So, VVV comes up on our Young Aristocrats report. These are stocks that have raised their dividends every year for between 5 and 9 consecutive years, right? Because traditionally, the dividend aristocrats have raised their dividends 25 straight years. But by the time that's the case, you're probably not early in the cycle of a company. So, 5 to 9 years of consistent dividend raising is really interesting. And then, of course, we're sorting by momentum and relative strength and all that other good stuff. And this one caught your attention. Why is that?
Yeah, I mean, obviously, the first thing that always catches my attention is the price action, right? I mean, that's what we do. We're a price action shop when we get right down to it. I read the report and then we were talking this morning about what we're seeing. And, look, again, at the end of the day, all that matters is price. But, the story behind it still is pretty interesting. I mean, with the dividend history that we see and the fact that it's breaking out to all-time highs. And, I mean, the backdrop of what's going on macro world with like supply constraints around the world is making it hard for people to buy new cars. So people are trying to get the most out of their existing used cars. A company like Valvoline is right in the sweet spot to help people out with that kind of stuff with all their retail shops and blah, blah, blah. And look, that makes for a great story, like I said. Is that going to help us in the next 3 months in my options trade? Probably not, but it might. It might. So that's why we bring it up. It is interesting. But I mean, when you're zooming in on that chart right now, if you have the chart up on the screen, that price action over the last, let's call it 5 weeks or so, that feels to me that there's just eager buyers that are snapping up every dip in that name, trying to be quiet, trying to be discreet about it. You got the institutional money coming in because they like the fact that it's a great dividend payer. You got swing traders who are maybe starting to feel a little FOMO, think this thing's about to take off without them. And you got day traders. They have little alerts popping off whenever a stock makes an all-time high and they're jumping in. So all that stuff is conspiring to me to manifest into the price target that you guys are seeing up near around 52 over the next several months. It could happen.
What I like
I'm not
about
saying
this,
it's
Sean,
going to happen.
it's a mid cap, and mid caps are so underrated. These are like the Jan Brady's of the world. Like everyone's either worrying about the mega cap, big cap stocks, or the small caps. What are the small caps doing this rate? The mid caps is really where the good party is, because by the time you're a mid cap, you've already proven yourself. You're no longer a small cap, but you're still small enough that you can double in market cap. You could double again and then double again, and you're still not that big. So, for me, I think mid caps are a place we want to continue to look. Valvoline right in the sweet spot of that $6.5 billion market cap. Are you kidding me? $6 billion? That's like, Solana in one afternoon. Like, right?
And it's flying under the radar. So look, we want to get long here, and I feel like the best way to get long with options is just to keep it simple. I'm just buying long calls here. I chose the April expiration because that gives us enough time for this thesis that we have to play out. They're only offering strikes at 35 and $40 a share. So 35 would be like at the money, and the next strike up would be 40. So I chose the 40 strike. They have a delta, last I looked, around 30, which is pretty close to my sweet spot. You know how I love that 25 delta lifestyle, JC.
I like it myself.
Yeah. So we bought the April 40 calls, paid about a buck. I paid exactly $1.50 for them. Look, man, if this thing makes that run up north of 50, we're going to get some sweet leverage in those calls, man. We're going to get an opportunity to 7, 8, 9x our money on that. I'm not saying it's going to happen, but the possibility is absolutely there. So
we've seen it happen before. I mean, it's happened quite a bit. So it wouldn't surprise me one bit if that happens. Let's talk risk management and strategy. So just to be clear, we're buying the VVV April 40 calls for approximately $1.50. Talk to me about what happens when that $1.50 premium turns into $3. What are we doing?
We're selling half of our position. That's what I always do with long calls. I love to sell half of my position when I've doubled my profit, or my profit is doubled, right? Doubled my money. So what that does, JC, we talk about this all the time, but for those of you hearing this for the first time, when I could sell half of my position at double what I paid, that gives me all of my original risk capital back. Now I basically have no risk in the trade and a free ride on the rest. And
what does that let you do at night, Sean? What does it let you do?
It lets me sleep at night, JC. I see what you're doing. You're teeing them up and you're just letting me knock them out. I see what you're doing.
I've been watching too many Sean videos, right? I know where you're going with this. And Sean makes a great point. And that feeling of selling half at a double, and now you know you have a free ride, in this case until April. I mean, it depends on when we sell it at a double, if we even do that. But, that feeling of, boom, I got my money back. Now, from here on in, it can only be profit. I can't lose anything. Man, you really do sleep better at night knowing that. It really is a great feeling.
Yeah, and it really helps give you patience, patience is what you need to ride a big trend. And we don't have the chart here. I'm throwing you a wrinkle here, JC, but just as a good example, we've been talking about it this week. We're in a USO trade that we've been in since February of this year. So we've been in it, what now, 10 months, 11 months now, and it's going our way. It's been going great, but we've had to kind of sit through two pretty significant sideways consolidations. And you know what? The fact that I was able to sell half of my position at a double very early on in the trade, it gave me that superpower to just kind of sit back and just let it do its thing. I had no care in the world about it because I knew I couldn't lose money. It's a great thing.
Here's that oil chart right there. Really allowed us to stay in the trade because it was house money. So that was the idea, is take half off the table. Now we no longer have any risk. Let it go.
Look at that, folks. JC had no idea I was going to throw in that USO thing, and look, bam, he's got the crude oil chart ready to pop up. Man,
I just hang out with oil charts in my back pocket in case anybody wants to talk about it,
You're a true professional, JC. Right on.
All right, so let's reiterate this trade one more time. The risk management is implied in the trade, right? Because you can't lose more than we pay, which is $1.50. These are the VVV April 40 calls, again, for $1.50. Sean, any other thoughts on risk management other than position sizing going in? What do you think there?
Yeah, one last piece is, look, we go into the trade with the possibility, understanding the possibility that we can lose all the premium that we paid. If Valvoline tomorrow, some news comes out and the stock gaps down to $10 a share, we're going to lose all of the premium in the calls. I don't think that's going to happen, but the risk is there, so you have to size the position properly, which is what we always do. That said, I'm looking at the 35 level in Valvoline. It's kind of hard to see on this chart because it's a weekly chart, but if you're looking at a daily chart, it would look more obvious. 35 is a pretty significant level of nearby support. And so if Valvoline can't hold 35, if we see a close below $35 a share, that's my signal to get out and reassess from the sidelines, because we're either wrong or we're early, JC. In either case, I'm losing money and I don't like it. So we're out.
Yep, that's exactly right. If this is a breakout, it's a breakout. If it's not, we're going to know pretty quickly. That 35 level is nice. It's a little tight. But I don't hate it. I like your aggressiveness on the risk management. I like that, Shawnee. I like it.
Well, look, it had to be kind of tight because we have kind of a shorter window for this trade to work. I mean, we're thinking this thing, if it's going to do what it's going to do, it's going to do it over the next couple of months. So, when you got that short of a time frame, you don't want to give it too much room.
Hey, not every trade needs to be a risk reversal, Sean, right?
Sorry, JC. I know every morning JC hits me up. Sean, what are we doing a risk reversal in today?
Well, big or go home, baby. But no, we say joking around. There's a time and a place for risk reversals. There's a time and a place to just buy the calls. In this case, for example, if it would cost more to buy this premium, chances are we'd need to sell something. So if we're selling puts, there's your risk reversal. If we're selling out of the money calls, that's another more conservative way to do that. But with implied volatility low, none of those things are necessary. Just buy the damn calls and call it a day, right?
You nailed it on the head, JC. Man, it's almost like you've been learning something from me over the last
Somebody's
4 years.
paying attention. Somebody's paying attention. Listen, if you have any questions, you know where to find us. info@allstarcharts.com. Follow Sean at Chicago Sean on Twitter. Follow me and the folks at All Star Charts. And if you want to say what's up, send us an email.
Take care, everybody.